Good afternoon, everyone. Welcome to the latest webinar in the series from Giant Group. We're going to be talking about all things merger and acquisition from a staffing firm and HR tech business perspective. It's going to be super fascinating today. So as always, we're really keen for you guys to ask questions as we go through the session. The best way to do that is to pop them into the Q&A box on your ribbon bar at the top, and then I'll make sure that I can work my way around to those questions to pose to Thomas at the end of the session. We will just wait a couple more seconds to see if a few more people sort of join in as we speak, and then we'll kick off. So also feel free to introduce yourselves if you wish in chat. Say hello, let us know where you're from and your interest in the session today, and then we'll get started. Okay, so I think the joiner numbers are starting to level out. So I think we're in a position to start moving forward. So good afternoon, everyone. Welcome to this webinar, the M&A Playbook for staffing firms and HR tech businesses, what every business owner needs to know. So in this session, we're going to focus on the fascinating world of mergers and acquisitions and how business owners in the staffing and HR tech space who are thinking about a sale or an event in the future can sort of best navigate through the process. And often that's a new experience for people. I'm delighted to be joined by Thomas Kardos today, a partner at Blackwood Capital. Thomas, would you like to just say a quick introduction?
Sure. Hi everyone. My name is Thomas Kardos. I'm one of two partners at Blackwood Capital Group. We're a M&A advisory firm focused on what we call nowadays tech-enabled human capital services space. But I think we can also call it staffing, recruitment, and HR tech for the ease of it. We advise both on the buy side and the sell side globally. We're based in London. We've got an office in Frankfurt. We've completed transactions across Europe, North America, South America, Middle East, Africa, and Asia. And M&A means basically that we help either owners of companies or corporates to sell their business or a division, or we help potential buyers in acquiring target companies.
Super, cool, great. Thanks, Thomas. So what we've decided is the structure of the session today is we'll run through some set questions that I'll pose to Thomas to address on a couple of topics that we've planned out. So just to run through those, the first topic we're going to cover is how a business can prepare for sale. How do you get sort of business sale ready? We'll then look at valuation, which I'm sure is always an interesting topic. What are the key factors around valuations? What's the current market dynamic when people are trying to determine a sales price for the business? We'll then look at different buyer types and how behaviors between those buyer types can also change. We're then going to move on to look at the do's and don'ts of entering a sales process. So we'll tap into some of Thomas's real life experiences, both the good and the bad and the ugly, no doubt, of how sales can progress or how they can come to a halt. We'll then move on to talk about post transactions. So, what are the considerations there for planning for life post the deal? Thinking about things like communication, who needs to be considered. So who and when are you going to be communicating the sale to make sure that lands really positively with all the stakeholders? And then we'll finish off with Q&A. So as I said at the start, if you can submit your questions as we go through, I'll make sure we leave 15-20 minutes or so at the back end of today's session, and we can pick those questions up. So Thomas has introduced himself. I'm Dan Haslam. I'm Chief Business Development Officer for Giant Group. So I'll make sure I can put the questions to Thomas today. So let's begin then, firstly looking at how a business and its owners need to prepare for sale to ensure that the business is sales ready. So Thomas, when you're first speaking to a client, what are the key things a business should have in place before even considering a sale?
I think first thing is that it's important to have made the psychological decision to enter such a process and to want to sell, because it is an extremely time-consuming process, and it's not something you can just do on the side. It needs to. It requires a lot of focus. It requires a lot of preparatory work. It also requires reflection about who in your team do you involve, because oftentimes one owner doesn't have all the information that might be needed. So I think it starts with that declaration of intention, even if it's an internal psychological one. After that, it is really important to, and I'm not saying this because I'm a corporate finance advisor, I'm saying it because history has shown that without an advisor on your side, things can go very badly. The most important starting point, you typically have a legal advisor, you might have a tax advisor, but you have a corporate finance advisor, which I think is critical when you start the process, because you don't want to start talking to potential buyers without being well prepared, because buyers will exploit any weakness, any inconsistency in communication, in numbers, in anything that is presented. Therefore, the first step is really to bring on board an advisor. Clearly, we look at numbers, so reporting, so we go from there. We have a list of items that we look at, we go through it, and then we start preparing.
I mean, you made a great point straight away there. Just the fact that the owner could externalize the thought of them considering a sale is obviously could be disruptive to other people in the business. So it's also just at an early stage thinking about, first of all, then mentally committing that this is what we want to do, and then how you're going to start engaging the SLT team, probably just to start opening that conversation up. You know, how far in advance do you think an owner should start preparing the business if they're then thinking that a sale might be on the horizon for them?
I don't think there is a kind of right or wrong on average answer, because there are some people who say, who start off with saying, in 3 years, I'm going to sell because, I don't know, they turn a certain age or there's a certain milestone. I do think that, so when we get involved, we typically suggest that it'll take 2-3 months to get ready. So that will give you a guidance of, if you want to have a transaction done by a certain time, your average sale process will take 6 to 9 months. So I would say 9 to 12 months before you want to have a sale completed would be the right time to kind of decide, or at least start thinking about getting ready.
Yeah, I suppose that 3-month piece is elastic as well, dependent upon the level of reporting and what the cadence of the company is from a KPI perspective, no doubt, and what they're reporting up as well.
Of course, and it also depends on complexities. You know, are you a company operating through one entity in one country? Are you UK only? Are you UK, US, Germany, and I don't know what, in which case it becomes much more complex. Is it one service line? Is it different service lines? So, you know, all of that, of course, plays a role in how complex it and how long it takes to get ready.
Yeah. I mean, obviously, you could anticipate that, you've already touched on it, the financial information that's needed to prepare for sale is going to be key. Just try and bring that to life a little bit for the audience then. What are the sort of things that you will be pulling together in the pack from a financial perspective that people would need to think about?
So a buyer will typically want to see 2-3 years historic performance, a current year budget, and at least 1 year out, ideally 3 years out. Clearly, you know, the further out you go, the more a finger in the air exercise it is. But and especially privately owned businesses don't necessarily have 5-year business plans that they work with. They might have their bank where they have a 12-month rolling forecast, but we would typically try to put something together, kind of some short-term 1 to 3 year view. The key indicators, the businesses are valued on EBITDA. So I think that's the first key point. And the important thing is EBITDA, just as an explanation, is earnings before interest, tax, depreciation, amortization. It is the closest indicator to cash flow, to operating cash flow. And people look at sustainable EBITDA. So, you may have owner costs running through the business that are not really operating costs. You may have had some investments or non-recurring items running through the business. So it is important to also, as a positive adjustment, to show what is the sustainable level of EBITDA going forward, and are there any costs that aren't really of operating nature that one could adjust for? The other relevant pieces, of course, are revenue and revenue growth and forecasts, as well as gross profit. So gross profit is an important indicator because it is very difficult for a buyer, unless the reason for the acquisition is to fill a pocket, a vertical, a geography that the buyer doesn't have. It is very difficult for a buyer to easily improve gross margins. What a buyer might be able to improve is the conversion from gross margin to EBITDA, i.e., how effectively, how efficiently do you operate?
Mm-hmm.
And the UK, of course, is a relatively low gross margin country compared to German staffing or French staffing. French is also low, but higher than the UK. US is much more attractive. So those are the key points that play a role.
Okay. And obviously you framed it at the beginning that your client base will be both recruitment businesses as well as tech businesses. Are there any key differences in the financial ratios, metrics between those if you're looking at a staffing firm versus a platform, let's say?
Yeah, of course. I mean, tech as a general, I think, theme is valued differently.
Mm-hmm.
You look at annualized revenue run rates much more than necessarily profitability. It depends how mature the company is, I would say. Whether it's revenue generating, whether it's still kind of running a monthly loss, a monthly burn, or whether you've reached break even. So yes, pure tech businesses are valued differently. Depends what they bring, whether it's a subscription-based model, whether it's a platform, and so on.
Okay, great. Let's move on to the next topic then. This will be a good one for everyone. I'm sure everyone's ears will prick up on the subject of valuation, and what the sort of key factors are then in determining a sales price. So again, Thomas, from your experience, what are the sort of key factors that separate businesses that attract premium valuations from those that don't achieve?
So firstly, a business is like a person buying a house. Some people will like a house and will pay more for it, and others will either not like the house or wouldn't pay as much for it, although it's the same house. It's the same with companies.
Okay.
But the general indicators, are your market positioning, your specialization, your margins, your size. Size matters. So larger companies tend to command higher multiples than smaller companies simply because they're more diversified.
Larger based on what, gross margin or turnover, or
both?
Okay,
I would say.
Okay.
Right. If you have an MSP player with very large revenues, that matters because that is the purpose of an MSP. Then the question is, how efficiently do they do that? And you look at kind of the conversion between the gross profit and the EBITDA.
Yeah.
So size generally is of importance. It also attracts a different buyer group. We have two types of general buyers. We have trade buyers and we have financial buyers. And within both, you attract with size a different group of buyers, and typically the larger ones are more sophisticated on the whole, I would say, than the smaller ones. Yeah.
Okay. Yeah, understood. And again, touching on the topic you were thinking on the last section around sales and on ongoing business. Obviously, some companies will have greater or reduced reliance on key clients, particular important contracts that they've got within the organization. So how does that affect valuation and how buyers' appetite? Because I suppose to your point, if you're looking at the bigger businesses create more value, that probably is also because they're watering down their reliance upon any particular key client. Yeah.
Absolutely. I mean, we're currently working with a group in the US that is a preferred supplier to one of the big tech firms. And that's the good news. And it comes with, they're delivering basically one of the top 22 suppliers to this tech company, which is very difficult to get into. The flip side is it's 60-70% of their business. So there's a huge reliance on it, and there's a huge customer concentration. And of course, if that were to fall away, the business immediately becomes loss-making. So it typically is better if to have a balanced portfolio of clients and not too much client dependence. But you sometimes, if you want to be a big player in the tech space, then you clearly want to be, Microsoft has a 600 million annual buy in the US alone for VMS.
Yeah.
You want to be in that, right? But implicitly, if you're a smaller company, it will be a big portion of your revenues.
Yeah. Yeah. No, again, makes sense. And obviously a ratio that we're all familiar with is the sort of 80-20 rule of 80% of your business coming from 20% of your clients. So when you're thinking about concentrations within companies, are there any particular percentages or that you're looking at as to, okay, well, when it swings to, as you mentioned, 70% of the business being tied up with one client, then that becomes risky. Is there a good sort of spread that you would recommend a business to achieve?
Yeah, I mean, I would say you would want, your top 3 to 5 clients in the 10-15% range.
Yeah.
Then move to the next layer, takes you to 30%. Ideally, but I don't think that should be the business philosophy necessarily, because you need to be, as an entrepreneur, you need to be a little bit opportunistic and go after where your opportunities are.
Yeah.
And I don't think it makes sense to turn away a huge opportunity just because it then becomes a big part of your business. You then just need to move on from there and try to build additional legs, other customers, to diversify.
Yeah, and yeah, I suppose that's one of the risks around this, isn't it? That the process of a sale and getting sale ready can sometimes disrupt, shall we say, or flavour the business strategy which got the business there in the first place. So you want to be balanced. You need to balance it in some respect. But I think you've started to give a picture of what some of the main factors are, EBITDA, and then talking through up from there.
Maybe just before I come to that, you just mentioned one important thing. One key thing, which I always tell clients, is when you want to sell, you need to run the business as if you weren't.
Yeah.
Because one thing that will always come back to haunt you if you say, I need to try and improve my cash position, I want to try and win some clients just to have higher revenues, if it's strategically the wrong thing, you will damage the business, and that will damage the potential success of the sale process, or at least the valuation.
Yeah.
Businesses should be run in the ordinary course to the extent possible, even if you are looking to do a sale. It is important that you do what is strategically right for the business, as opposed to what you think might be right for a buyer, because every buyer will have a different view on what's right. So you need to do what's right for you.
Yeah.
Coming to general multiples, it's a very wide array. If we look at recruitment, if we look at perm versus temp, if we look at MSP, VMS, RPO, if we look at tech, right? So there isn't one range that makes sense. There's also a difference between UK, Germany. There is a difference between Europe and US or Asia Pacific. and Middle East. So I would say in the UK, we typically see kind of the small mid-cap businesses in the 4 to 6 times EBITDA range as a multiple. That gives you the enterprise value. You then need to add or deduct net debt or net cash in order to come to the equity value, which is what the value of the shares is. And then you need to take into account that, especially in this sector, it is unlikely that a buyer, but we'll come to that a bit later, I think, a buyer will buy 100%, but then there'll be structures around how to buy a business. If you look at solutions players, so MSP, VMS, RPO players, where technology plays an important role, you tend to see higher multiples. That has 2 reasons. Firstly, the margin itself just numerically is lower because you have a high gross revenue number, which is basically the contract value, right? But your NFI equivalent or gross profit equivalent, and then operating margins tend to be smaller. But MSP players tend to have much higher conversion rates from gross profit or NFI to EBITDA. Mm-hmm. That drives valuation multiples. So to give you an example, we advised last year a Dutch group head first on the acquisition of Impellum mm-hmm. Group, the entirety. And the Dutch guys are pure MSP solutions player. They converted round about 55% from their gross profit to EBITDA. Impellum, which of course is a large player, does different things, had an average conversion of just above 30%. If you look at plain vanilla light industrial staffing in the UK, if you get 15-20%, that's not a bad number.
Yeah.
But that drives also multiples. So a head first or a solutions player will be valued at 10 plus, whereas a smaller, pure light industrial staffing player will be valued at 4, 5, 6. Right. So I think you need to keep that in mind.
Yeah, no, super interesting. Like you say, when we talk about the market, there's a whole variety and range of different businesses. So it makes sense that there'll be different sets of variables around it. I mean, we're talking about the upside here in terms of, sales value. How about the downside? What's the factors that can be a drag on valuations? Are there any sort of common red flags that you see around contracts, payroll, worker classification that impact sales valuation or even stop a sale from progressing?
Yeah, I mean, clearly anything regulatory that is a risk, mm-hmm. Whether it's around worker classification, whether it's one big topic is GDPR and data protection and those kind of things. Those are always items that are being due diligenced in great detail, and where you need to be sure that you're up to scratch with current regulation, and you need to know what you're doing. The most common, I would say, reason for processes not going the way you want, and this is something which has been quite common in the last 24 months, I would say, is financial performance during a sale process. And this is purely a virtue of the market that we're in, or that we have been in for the last 18, 24 months. People were, for the last 2 years, always quite optimistic of what is to come.
Yeah.
Prepared budgets in line with that relative optimism. And of course, starting with the large S3s and Hays down to small companies, no one's managed to meet their budgets. That drags in several ways. It can kill a process because you as a seller say, I don't want to sell at that price. A buyer can say, company isn't just simply not delivering, and I don't want to buy myself more headache. I've got enough issues at the moment myself. It's difficult to set a value where you have a lot of uncertainty. So that, more than I would say regulatory matters, has affected both volume of deals, willingness to do deals, and the ease of getting deals done.
Yeah, yeah. Although I suppose you can spin it a couple of different ways there. If there is, you're right, we're obviously in a slack market at the moment. So perhaps if it is a good fit and someone is keen to buy, it could be an opportunity for a good price to be negotiated. Whereas if you wait for an uptick or an upturn in the market and you jump into sale mode at that point, then inevitably the price is going to go up as well as a result. So it's just, like you say, so many different factors you need to think about here in terms of positioning, time, etc., to get the best result.
Yeah.
Okay, let's move on then to the third topic, which I know you're keen to talk about, around different buyer types and behaviours. So can you just give us a bit of a flavour of who are the main types of buyers that you see operating in the staffing and HR tech sector?
Yeah, so clearly, I've alluded to earlier already, you've got trade buyers and financial buyers as two main categories, right?
Okay.
Trade buyers are larger market participants, competitors, and in fairness, I think we can say that for the last 24 months, it was mainly the trade buyers transacting. And I'll come to the reasons in a second. So trade buyers will buy with a strategic intent. There is a geography, a service line, or a combination of the two missing, and they want to strengthen in that space. They will typically integrate. Some will, depending on the size and so on, some will keep the brand, for example, or merge the brand into their own structure within 6 to 12 months. So there are different models, and typically there is an expectation that senior people, owners, especially if they're active in the business, stay on board at least for a transition period, if not longer. And typically transaction structures reflect such a transition period. So, there will be a majority acquisition at the outset, and then there will be kind of a phased deferred payment plan or earn-out mechanism. The other pool of buyers are the financial investors, private equity firms on the smaller scale, or for tech companies, venture capital firms. Let's differentiate for a moment between private equity and venture capital. Private equity are investment funds that buy into established businesses with existing revenues, cash flow, typically profitable. Venture capital funds typically invest into earlier stage companies that mostly already have revenues, probably aren't breaking even, or maybe just about breaking even, and or may not generate cash flows yet in a significant way. So that's generally the difference between private equity and venture capital. The private equity model, more than the venture capital model, the private equity model is driven by the availability of debt financing. So whereas large corporates might have the cash on balance sheet or might have facilities from which they can fund an acquisition, private equity firm, historically, in order to generate the returns, they will always look to complement an equity investment as part of the purchase price with debt investment. Now, as we all know, interest rates have been very high 2-3 years back. In the US and in Europe, they have fallen dramatically. In the UK, we're still lagging behind. So it's still much more expensive to borrow sterling debt than it is to borrow euro debt or US dollar debt. And that has restricted the appetite, along with the market trends in the staffing world generally, of private equity firms to be active. We've seen some larger transactions, and we are now seeing increasing activity from private equity as well. But the PE buyers have been a little bit hesitant. Now, private equity, as a concept, they become a shareholder, a majority shareholder typically, but they will want to work with the existing team. So it means that you as an owner or you as a senior team need to commit to a 3 to 7 year period during which you continue to grow the business. You might have some technological investment plan. You might have some buy and build agenda. And you're part of that journey until that private equity firm exits. The private equity firm invests knowing that it will exit. The trade buyer will invest with the objective of integrating it into its operations. I think those are the two key things. If we move to HR Tech for a moment, briefly, venture capital sometimes also uses debt. Typically, or oftentimes, it is a consortium of several VCs that come together. They also look to exit, but they look to they typically fund mostly with equity, and it's really a huge growth story. And then either doing additional rounds of financing where they may stay in or may exit, or ultimately work towards an exit as well.
Yeah, okay, fascinating. Yeah, I think that's super important to understand the drivers of the two different buying groups as to how they come in, and that's obviously going to have an impact on why they're looking at acquiring that business, whether it's to get in multiple, or if it's, like you said, a strategic buyer interested in plugging a gap in their operation to improve that move from gross margin down to EBITDA, for example. You've obviously spent lots of time with the different types of buyers. Were there any particular differences you'd highlight to the audience in terms of how the two behave, private equity versus trade buyers? Any difference in approach?
Yeah, I think one thing that is different also, and you need to be aware, I think, at the preparation phase already, you need to assume that private equity people are smart, but they don't really understand your industry in detail. So they will, in all likelihood, the due diligence process with private equity folks will be more complex in the sense that they will want to do commercial due diligence. They will want to understand the drivers of the market. Whereas a trade buyer will know the market extremely well, might have differing views of the market than you, but that's not, that's permitted. It's more that you don't need to educate them. And it sometimes, there are processes where we speak only to private equity firms because the owner doesn't want to sell to a competitor, and there are processes where we only speak to trade buyers because they don't want another round of, or they don't want a round of 6-7 years with a PE firm. They think the natural exit is into a trade buyer, and you would adjust the preparation accordingly, depending on whether you speak to one, the other, or both.
Okay, yeah, makes sense. Just as a reminder to everyone, if you've got any questions on these topics that you want to float across to Thomas, then please do drop them in the Q&A, and we can pick them up once we've gone through these set topics. I think you've covered off Thomas, who's more active at the moment in the market. It has been more trade buyers, although you're starting to see some PE firms start to be active. So I think let's move on then to the next topic, the do's and don'ts when entering a sales process. So hopefully we're not going to drag up too many bad memories here in terms of tapping into some of your real life experience of the good, the bad, and the ugly of how sales can progress. But I think it's going to be fascinating if you can share some insight there. So first question I had is, how important do you think it is to run a competitive process rather than sort of negotiating with one buyer?
So I think generally it's always healthy to have more than one party in a process, if only to keep the one natural buyer or the one buyer you want to do a deal with honest.
Yeah.
We do have situations where we speak to one buyer as a seller, or where as a buyer we speak to on an exclusive basis on a proprietary deal. The advantage is that you are more likely to maintain confidentiality for a longer period of time. You may not be able to maximize value because you don't know what is out there, who is willing to pay an extra penny, right? And even if you might be happy with the price that is offered, there may be someone out there who is willing to pay more. So I think those are the two main topics. But good, bad, ugly. We had one sale process where we started preparation.
Yeah.
We were looking at a company which, according to their management accounts, generated some 5 million of EBITDA. That was not only what they told us, but what the owner believed and what, everything was built on. Luckily, in that process, we also, in addition to what we call the information memorandum, which is kind of a sales document that we prepare as a corporate finance advisor, because there were some carve-out points and there were some reconciliation points. So we recommended that a vendor diligence book or a financial fact book was prepared by an auditor in addition. You do that sometimes in some processes, especially also when you speak to private equity firms, they quite like that. Makes the due diligence process somewhat easier. Anyway, it turned out that the 5 million EBITDA was actually 2 million EBITDA.
Okay, ouch.
Luckily, we found out before we went to market.
Okay.
Clearly, for the owner, this was bad news because, on the one hand, one asks, how can you think you have 5 million EBITDA if the cash at the end of the year is much lower? But I don't know whether Anyway, it wasn't aware that it was only 5 million, that it was only 2 million instead of 5. But clearly, if we had gone to market and had solicited offers based on 5 million and someone starts doing diligence and we're talking about 2 million, this is a completely different ballgame.
Yeah.
Right.
Yeah.
So these things happen. Therefore preparation is key.
Yeah, I mean, imagine all the time spent in terms of positioning the business for that to be, waiting further down the line. I mean, obviously, it's easy to sit here and say, oh, how can someone not get that valuation right? But as we all know, businesses can be hugely complex, and it probably does require some due diligence. So you obviously sounds like you work with a team then when you're going in on these deals. You've obviously got a number of other people that you can work with to sort of pull together to give advice and look at certain parameters. What typically would be the sort of team that you would have going through a sale? It's not a planned question, but I'm just interested to think about what the sort of people are.
No, so again, it depends. I mean, as I said, you typically have kind of a seller will typically have the corporate finance advisor, M&A advisor, then a legal advisor, sometimes a tax advisor in terms of structuring, how to best structure the deal, how to best get the money out from a personal perspective, personal tax perspective, etc. Occasionally, we also have one of the auditing firms do a financial fact book or a vendor diligence report. And that is really there to preset. We will not do an audit work. We will take the company's numbers. We will ask critical questions, but we're not going to go through the bank accounts, verify things. We're not going to do an audit. That's not our job.
It's not forensic, no.
No.
Okay. Good question for you. Given that we've got some business owners on the call today, how can an owner best use advisors like you to add value during this process, Thomas?
Listen to them.
That infers that sometimes people don't like the advice that you give, right?
Yeah. I think our job is more than to try and get a deal done. is to give honest advice, because I believe what goes around comes around. And if I talk someone into something that I don't believe, then I wouldn't be sitting here 30 years later. So, we have the experience of doing this day in, day out. And it sometimes is important to take a step back and M&A is not rocket science. It's making the right judgment call in certain moments of time. That's based on experience of having done 100 odd deals in I don't know how many different situations. That really is, in my mind, the most listen to your advisor.
Yeah, because as we said at the beginning, this can sometimes be the first time that people have gone through this process. Whereas, if you're going through many transactions that complete or don't, then you'll start to get a sense as things progress as to where some of those dangers and pitfalls can be. And obviously, it's in your interest to complete the sale. So I think that's good advice. Although I'm sure that you're dealing with a lot of emotions and a lot of egos in this as well. When you've got a business owner who's could be their life's work that they're looking at putting to market, and so I'm sure that can be fraught sometimes.
Absolutely.
Looking back on the deals that you've worked on, what do you think's the best lesson learned from a deal that went wrong?
I can only repeat what I said at the outset. The most critical point is being ready, getting prepared. Don't talk to buyers before you've hired an advisor and your advisor understands your business. Because whatever information you give out, it will be different from the information later in the process, and a buyer will chip away at whatever indication they gave you in terms of value with every change there is that you come up with.
Yeah.
So I think that is, preparation is absolutely key.
Yeah. Makes sense. Okay. So final topic then. We're then thinking here now about what to consider post-transaction. So the deal's done, but we've all got a plan for life post-deal. So how should business owners approach communicating a sale to the staff? When's it the right time to do that? What's your advice here?
Yeah, so I think this again depends on your setup and the business, and whether you're the size of the business, how much knowledge do you as an owner have, versus to what extent do you need your senior managers involved.
Mm-hmm.
It is a very time-consuming and intrusive exercise. So you need to be able to access a lot of the detailed information during the process in order for a buyer to do due diligence, which means in most, I would say nearly all cases, you need to involve key managers. Of course, the topic of a sale always creates uncertainty, because every person for themselves will ask, well, what happens to me if that happens, right? What's my future? Do I have a future? And so on. And of course, if you have 2 or 3 people, you can sit down with them and discuss it and listen to them and manage it. If you have a staff of 50, 100, 200, 500, 1,000, it becomes more and more difficult. So typically, in a process, at the beginning, you have only the owner or owner plus senior management involved.
Yeah.
During the process, that stays the same. And it's only once a deal is agreed, signed, maybe not completed because you might have regulatory approvals, but when it's legally committed, then you would typically announce it to your own workforce, the buyer to their workforce, to the clients, to the market, etc.
Everything
that needs to be
time,
carefully
right?
orchestrated and managed.
So you're an advocate for that all happening at the same time, then communication to internal as well as external stakeholders.
You would typically do first internal, and then half a day or a few hours later